So what we will do today is combining what we know so far, again, intraday traps. So again, intraday traps, combining the knowledge of what we know so far to give us an advantage over pretty much 99% of traders out there. We have to keep in mind that what inducements are and how they constantly trap other traders, not only on an intraday basis, but also on the bigger aspect of it. Again, it's not only intraday trading, it's also looking at the higher time frames and combining the overall plays and then figuring out what versions do you have. Do you expect like a daily reversal, like a perfect daily cycle with a reversal in New York? Do you expect a retail heaven where they induce low and then, induce high and then go even higher? Or do you expect like inducement low and a knockout and then they continue in the other direction to stop everyone out? That's possible too. So inducement trade identification, inducement of timing, and of course, always trade away from those traps. So a very easy example. Again, first thing what we do, identify liquidity for this specific day, but plus we look to the left, at least a little bit intraday, right? So what do? We first we identify where our liquidity is. And of course, in this scenario, it's very, very easy because where's the liquidity? It's right above in here, right? So they're already starting to building up this channel, easy stuff. So you already know what they're trying to do here. You know their intentions. You know what's closest to them is now this upside liquidity right in here, of course. So what do you expect, right? So based on timing, now you're combining the understanding of liquidity with starting the cycle. So you look at the clock, right? So it's 7:15, so 10 minutes before even Frankfurt Open. So what do we do? Of course, you include the timing windows, right? So first of all, we're talking about cycle. So build up, what should come next? Inducement with timing and then mitigate something for completing the internal cycle, the intraday cycle. So what do we have? We combine now, first of all, our mitigation areas to know where it should stop and also when it should stop. Again, we have our two mitigations. So in here, decisional plus this extreme in here, right? Because this is already mitigated. So this becomes your extreme and your decisional here. So where's it more likely to go? We had this example before, just to make it a little bit clearer, right? So again, these two areas, timing window is here. Just by logical understanding, would it make like whoop? Or would it make like right? Obviously a little bit logic in here. So we have two scenarios we can expect for this internal place in here already. Can look like this, craziness, or again, could look like this. Of course, what's most likely going to happen? Again, we did this discussion before. So which side do you pick? Very easy stuff already, right? So of course, the blue corner wins easily in here, and it look like something like this, confirmed with timing and the perfect cycle. Easy stuff on an internal basis. So sometimes you won't get your mitigation, but also the inducement. Again, that's very important to understand the bigger picture as well. That sometimes it doesn't need to be a mitigation of London. It can be a bigger picture inducement. Like here, you don't really have anything you should mitigate in here. So what's the next order thing? Asia range closes in here. So where should they mitigate? They will not mitigate like this and then go lower. That's not going to happen. What do? London comes in. They, of course, will look for liquidity and then go lower. So you identify your liquidity zones like this. Right now you see, okay, they're channeling upwards. So you're in a build up right now. Awesome. So you understand where liquidity should be taken, your zones, right? So you look for detailed inducement and traps. So is there inducement yet? No. Is there build up? Yes. Is there mitigation? No. Right. So what do? You combine it with timing, right? So now we're at the 50-minute. Okay. So we talk about timing aspect. So we can expect something like this. Because again, we want to induce something high to go lower if they're already building up liquidity all day long to the high side. They want to give the final inducement high to give breakout traders all the final reason to getting induced now. Then the daily cycle is completed until London. Then they can reverse the whole market on them. So it will look like this, right? So look at this point. That's the inducement trade in here. They need to induce as much as they can with the timing. So we look at this point in here. And then do what? So now we're having our inducement perfect to the minute. So what do? We wait for what? Internal break of structures in here. and then mitigation, the inducement to complete the cycle, and then do what do you expect. Easy stuff, easy question to wake everyone up. What should we expect after this one in here? There you go. That's your perfect tube, right? Easy stuff. And just drink it quick. There you go. That's your tube. Easy stuff. And again, you trade it with the mitigation after the inducement, after the internal break of structure. Okay, after the daily cycle is played out, after you had your build up, inducement, and then you're trading this mitigation. See, it's always the same. This inducement doesn't need to mitigate something to your left if it's already an inducement. And you're trading the mitigation of the inducement after break of structure, after timing is confirmed, after daily cycle is confirmed, after build up, and everything lines up. Perfect. In other words, like how Will Smith would say it, right? But there's more, of course, like what's the next things in here. Then you expect, like you see this whole thing in here, you know, okay, huge tube happen, of course, sellers being very happy. So what needs to happen? They make them even more happy, right? So you identify your liquidity zones again. Next put would be here, right? And of course, here and here to induce even more people the wrong side. So what are you going on? So now you're in a minor inducement, but it's clearly not enough to reverse the market on them. So what do we need? Ignore that one because it's minor ones, right? Looking for a medium one, right? And then of course you're looking for build up, inducement, mitigation. So do you have an inducement here? Only minor one, but not enough to reverse the market on them. So we don't have an inducement, we don't have a build up, we don't have a mitigation for New York. And we know our timing window will be here. Okay. So what do? We just wait and expect something like this. This could happen. If this happens, we have a minor inducement, right? This is already filled. So this is not a mitigation zone anymore. It's already mitigated in here, right? So we need an inducement and then a possible mitigation in here after a build-up. So what do? We expect something like this, right? So when we look it up even more. So now what we have this smart money trap being induced to the low side. New York opens, tapping into this weird zone in here, building like this weird equal lows in here, right? But our mitigation zone with the imbalance is all the way down here. And what does it do? It lines up with timing perfectly. So what do? You wait, jump into the lower time frame, then you see channeling upwards, going sideways now. Timing is right around the corner. So of course you expect something like inducement, break of structure, mitigation. It's always the same, in line with the perfect timing, right? So what did happen, right? So of course you expect the inducement here, mitigation like this on the 5 minute now. And of course, this is what happened. And again, the overall play will be so perfect for you. And again, it just makes sense. And then of course, there's even more. Just by timing us back, now you're building up this buy side. People need to get mitigating their positions, right? So what will happen? Of course, remember London close is when London traders exit their positions, get liquidity out of there. So that's why to the minute, liquidity starts to fall, ranging, and then they start reversing because liquidity is entering. But that's a perfect daily cycle of an inducement, perfect cycle to the upside, perfect cycle to the downside, build up before it, inducement into the mitigation with timing. You wait for the break of structure, enter it here, and you get out London close to end of the daily cycle like perfect.